Is anyone in here familiar with, I was just reminded of a quote, anyone familiar with Jesse Livermore and who he was, right? One of the great stock speculators in commodities, but he died a broken man and by his own hand, broke, but he made over, several fortunes over his lifetime. I think at the height of it in 1929, at the crash, he had something like over $30 million, 1929. But he said the two most important things in trading, the only things he said, is knowledge and patience. So you're here learning, you're getting the knowledge. The patience, right? It's hard to practice, and it might be easier for some than others, but keep that in mind. And the risk disclaimer, I'm sure this is no one's first presentation. You've seen this, but please keep it in mind. Obviously, none of this stuff is foolproof. There is no holy grail. And there is definitely risk involved. Okay, so Ralph Nelson Elliott, the principle that's named after him, and this is a picture of the man right here. Okay, he discovered that crowd behavior tends to form patterns that recur over time, regardless of the time frames, regardless of the market. So we came to then realize that it must not be outside events and news events that cause markets to react if they all look the same. If you were to take, an oil chart or a stock chart and take off the time frame and take off the labels, you would see the same kind of patterns, right? You would see this 5-wave rally, a 3-wave decline, and so on and so forth, and triangles and wedges. You see the same patterns. So he came to the conclusion that it must be market psychology that dictates why markets move, okay, and why they're not stagnant. Markets are dynamic. He reasoned that's the reason, all right? And we'll obviously go on and expound upon this, but the psychology, right, that affects market price is based on a mathematical principle that's found throughout nature, including people, okay, and that's the Fibonacci sequence, and we'll go over that as well. Okay, so the principle of Elliott is based on the idea that markets are fractal. I discussed this in the first presentation this morning when I showed statistics about how markets tend to find their opening or high for a specific session at the beginning of that session. Okay, whether it's the beginning of the month, which I really want to make that point strongly because this is the beginning of the month, right? And there is a very strong tendency for markets to make the high or the low in the first 3 days of the month, or even more so the first day of the month. In fact, a 14% chance, right, that the euro dollar makes its high or the low of the month today. Right? That's much more than random. It would be 5% if it was random, right? About 20 trading days in a month. The same thing happens in the weekly hour, in the hourlies, right? High for the week tends to be on Monday, low for the week on Monday. Same thing happens in the intraday. Intraday seasonality, you have high and lows on the opening ranges, whether it's Asia, US, or Euro. All those things happen, and that indicates a robust fractal, right? The same things happen at larger time frames and smaller time frames. It's a like from like. And the best way to think about this, think of market structure as a tree. You think I'm crazy, but this makes sense. Okay? So think of the first branch as a trunk builds. That can be, think of it almost as a 1-minute chart, and then more branches form to make up the next part of the tree, and that would be your 5-minute chart. Okay? And those form. You have more big branches that form, and then you have a full tree, and you have a daily chart and a monthly chart, and so on and so forth. It's the same kind of idea in markets as in nature. Okay, and you can see kind of what I mean with that illustration, right? You have the 5 waves up, which is how bull markets tend to move, as well as down markets, okay? But within each wave that affects the trend, that would be 1, 3, and 5, they too consist of 5 waves, okay? And even from this small second and fourth waves, and within 1, 3, and 5, they would look like, if we were to put a magnifying glass on them, they would look like the 5, 3, 5, or some variation thereof. Okay, so this is the basic structure of all market movements. In FX, right? In FX, I look at it as more isolated Elliott wave patterns. You look for a major high or low and see if you've had a 5 or 3 wave movement from that high or low. That determines whether or not that movement from that point represents the beginning of a larger trend or just a correction of the prior move. Okay, I have no labels here because I kind of want you to think of it and practice yourself. You see that rally, you can see pretty clear that it was in 5 waves, right? Can everyone count that? 1, 2, you see there? I did this presentation, I think, or put these charts together on last Thursday, so these are pretty up to date. This was a 1-minute chart in the Dow, I think. Okay, so these patterns happen at all degrees of trend and all freely traded markets, which is one reason why, to be honest, the FX market is so conducive to Elliott wave. It is a purely free market. There is no exchange. There's not even an exchange, right? It's the largest market, so with the largest market, you have a large statistical sampling of people, okay, which is going to be the best visualization of human behavior. It's a very pure market. There's no, more lightly regulated as terms of, short selling. There's no uptick rule, blah, 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 right? It's very, very pure market. There's no crooked CEOs of a currency and so on and so forth. There's no Enrons in FX trading. Okay. Now, by the same token, that was a 1-minute chart I showed you. This is a quarterly chart. This is quarterly data of the Dow, and you can see from the low. That's from the Great Depression low. And you can see the 5 wave, I've outlined it obviously in bold red. You can see the 5 wave rally to the 2008 high. This is obviously quite ominous at the current juncture because you have the specter of a multi-decade top in place. Okay? And at the very beginning of a potential bear market, go more in depth in this in tomorrow's presentation, the outlooks and forecasts that I'm doing with John Kicklighter, but even if you zoom in on the top area, you have what may be forming a right shoulder right now and a huge head and shoulders formation. This is the euro recently from the November 2009 high. Okay, and a lot of people want to make Elliott extremely difficult, okay, but it's really quite simple. You're looking for this pattern. That's all you're looking for. You want to see the right look. You want to see, how is this actionable? Well, we see 5 waves up since the 1930s. Therefore, we probably shouldn't be buying stocks for the long term right now. Okay, the euro. This is a daily chart. We see 5 waves down from a major high. What does that tell us? It tells us that the larger trend is down because 5 waves are in the direction of the trend. Therefore, we should sell bounces. And sure enough, we had a bounce, right? We had a bounce on the Greek bailout news several weeks ago. On April 12th, the market opened much higher. That was the high. So you're looking to sell these major rallies. When you know you're in an impulsive downtrend, as we are now, big surprises should come to the downside. We're seeing that today with the euro. Okay, so let's move into, now that you've seen real markets and what they look like as far as the 5 and 3 wave movements, let's get into the basic pattern a little more in depth, right? Okay, so an impulsive wave consists of 5 waves and moves in the same direction as the trend at the next larger degree. So how would you use that to trade? Well, if you looked at a hourly chart and you saw 5 waves from a certain low up, okay, then you would conclude that the next degree trend is indeed up. Okay, that may be on a 4-hour chart or a daily chart. People do get confused a bit with degree. It's not the exact same as time. It takes just 5 waves to make 5 waves up, and then you're looking at the next degree. It may not be visible on a 4-hour or a daily chart. Time is really of not much importance in pure Elliott. People like to make rules about time and saying, correction shouldn't take longer than X amount of time against the impulsive 5-wave rally and so on and so forth. But degree and time frame really are not the exact same, although they are similar. Okay, wave modes, you have just impulses and corrections. Okay, within impulses you have motives. The point of motive, right, the definition is that it propels. Okay, it's the direction of the larger trend. Okay, and within that, 1, 3, and 5 are 5 waves, right? Think of the tree again. Those are the ones that have 5 waves within them, and that makes up the larger 5-wave move. Okay, so this is what a complete cycle would look like, idealized looking cycle, right? So let's go back to the Dow example, right, that I had, the quarterly data. If we were to say that left half of the illustration was a 5-wave move up, and each 1, 3, and 5 consisted of 5 waves, okay, and 2 and 4 was 3 waves or some variation thereof. Could be a triangle. We'll get into that in a little bit. Then we would expect something like that, okay, that would take perhaps the same amount of time or less, okay, or some proportion of, but we'd be looking for a retracement in 3 waves. So if we go back to this large stock market pattern, let's look at the first wave up in the 30s. You can count 5. It's kind of hidden by the line here, but you can see that's 5. Okay. Now we have 3. If you follow the arrow there. All right. And then we have a very long extended wave in 5 as well. Okay. So here's something like 1, 2. Okay. Then 1, 2, 3. Then that's 3. So it's 1, 2, 3, 4, 5. Then down 4, 5. Now we have a long sideways movement, and another 5-wave move up. 1, 2, 3, 4, 5. People can say whether or not they think that was some sort of a rally to a B wave high. I know this is getting a little complex, but I count it as the end of the entire rally. So the idea is that then you would be looking for something like that, okay, on the right side. How it's going to play out, you never know. So these are just examples in FX, okay? This is a trick that I like to do when I scan charts at the end of the week. I'll pull up weeklies and monthlies for the long term, and I just look at a line chart, just the closes, okay? That can sometimes show you the most pure Elliott waveform rather than getting distracted by a candle or a bar pattern or something, or the highs and lows, which may not be as important. To me, I don't think there's important. I think the close is the most important price of the day. That's the price at which it's settled. That's the price at which people are willing to take home a position overnight. Okay, everyone's agreed upon that price for the day, so that's what I look at as the most important price. But you can see this would be a Elliott in action right here. Okay, so the basic rules, there are really only 3 rules in all of Elliott. Okay, in motive waves, that is wave 2 never retraces more than all of wave 1. Right, so you're coming from a major low and you count a 5-wave rally and you drop below the low, then you start over. You are no longer in an impulse. Okay, wave 4 never retraces more than all of 3. In other words, once you have a series of higher highs and higher lows, you cannot break that series of higher highs and higher lows. Otherwise, the uptrend is by definition over. Okay, wave 3 is usually the longest, but it can never be the shortest. That's the third rule. Okay, and this makes sense if you look at any chart of any commodity or currency or equity. You tend to see the middle part is the biggest chunk of the trend, right? The end sometimes can extend as well, more so probably in commodities than in currencies, but the middle is the fastest rate of change usually. That's what creates divergence, right? Okay, the most common wave. There's 2 types of motive waves within impulses. Okay, or sorry, it's 2 types of 2 types of motive waves. There's impulses and diagonals. Impulses are the ones that are very clear and clean, right? The ones I've showed with the red lines. You know it when you see it. It's a fast move. It tends to be an emotional move. This is the Australian dollar from the top on a daily basis. You can see the decline from the top, the 5-wave decline, which at this moment is why I, longer term, would still be bearish against the upper 90s high in 2008, because that would suggest to me that this whole rally is indeed a correction. You can see the decline is fast, and that's an impulse. That's the perfect definition right there. Ending diagonals, the second type of motive. It can also occur in the first wave position as a leading diagonal, but it's a wedge formation, right? If you're more accustomed to traditional terms or traditional pattern analysis, this is just a wedge. It's a slow, sometimes frustrating rally or decline, right, with 2 converging lines. The triangle turns sideways. And it usually ends a move, okay? And it offers a pretty good trading opportunity. The specific setups for Elliott I'm talking about in the next presentation, which is at 4:30. But this is just an introduction to the patterns. An ending diagonal, it offers a wonderful trading opportunity because the move that follows it is usually very fast. Elliott said, I think himself, he said that these type of patterns tend to occur after a market's gone too far, too fast. Okay, and a perfect example of that would be the euro when it rallied to 160. Okay, that's what ended the rally to 160. I remember to this day writing that an ending diagonal was probably forming, and there would be an amazing shorting opportunity when it ended. How would you know when the ending diagonal completed? Well, you would know for sure when it drops below the wave 4 low, which would be here. I don't have a line on there, but that would be right there, right? But you could even have an idea as to when it would end here on the top, because you could measure using wave 1 here is longer than wave 3, right? Remember, wave 3 cannot be the shortest one. So we would take wave 3 distance, okay, extend that price movement from wave 4's low, and know that if it went above that specific level, the pattern's invalid. So that, is one way to also use Elliott. To understand what is possible, you have to understand what is not possible. So if a diagonal was taking place, we couldn't go above 162 whatever, right? Okay, extensions. It's simply an impulse wave that sports several impulses within it. It doesn't really matter what wave is extended, whether it's 1, 3, or 5. It's usually 3 or 5. Or both. But either way, you're going to be able to count a derivation of 5 plus a multiple of 4. Because if it's one extension, it's 9, like those bottom 2 would be. If it's 2 extensions, you'd be able to count 13 waves. Okay? If it's 3, It's 17, maybe you have an extension of an extension, okay? But it's something plus 4 or a multiple of 4. So once you can count that number of waves, you know that you're at an end, or the probability of a top in reversal or bottom in reversal is increased. Okay, corrections are much trickier than impulses. Impulses, you see when there's 5 waves up, and you expect some sort of correction, but you expect the trend that was in the 5-wave direction, whether up or down, to continue into the foreseeable future. Corrective waves, you have no idea what kind of correction there is. There's 3 main types, but you can have very complex, and often do have very complex corrections, especially in the 4th wave, or the second corrective movement within the 5-wave structure, waves 2 and 4. Okay, so you have 2 basics, either sharp or flat. All right, but within the flat area, you have triangles and what's then termed a flat. Okay, which could be thought of as a kind of a rectangle as well. So these are the subdivisions of what a correction is. Okay, they have zigzag, for example. 5, 3, 5 means the 3 waves. You have 5 in one direction, 3 in the other, 5 to complete it. Okay, so focusing on zigzags, this is what a zigzag looks like. And it's simple, and then a little more detailed on the right. And it's important to notice, too, this looks like an impulse, right? But it looks like the first 2 waves of an impulse, waves 1 and 3, or 3 and 5. Okay, but it's not an impulse if you had a preceding 5-wave movement that did not complete a larger pattern. This is this is zigzag in the euro dollar from the mid-90s high. I know the euro itself obviously wasn't trading in the mid-90s, but it's synthetic prices using Deutsche Mark rates. But the most important thing about a zigzag is the second B wave there is usually not even half a retracement of the first corrective wave down. And this also offers a good trading opportunity and end of a zigzag. If you take a line, a channel line, you can connect the top of where it began in the B wave and then project the end of the C wave, because it usually ends somewhere where a parallel line is then extended from the bottom of the A wave. Or if it was the opposite, it would be the top of the A wave. And when longer term charts, you have to do it with both log scale and arithmetic scale. I believe this is arithmetic scale, but it will happen with either one. Okay, and that doesn't always happen, but it happens a lot. Okay, flats. 335, there's much slower than zigzags. There's a lot more variations of flats, which makes them very tough to follow in real time, because oftentimes wave B goes above the origin of wave A, okay, and sometimes wave C won't even end at the terminus of wave A, and that would mean below the bottom of wave A in this, okay. In fact, wave B usually goes above the origin of wave A. It's called an expanded flat, but it's more common than a regular flat. Okay, this would be an example of an this is just a regular flat, because you can see B did not go below A there. But you can see within the subdivisions, you can kind of see the 3 up and then retraces most of it, and then a sharp rally to finish it, right? Now, I'm not even sure. I think this is an hourly chart that I had on the euro dollar. Okay, triangles. People are much more, familiar probably with triangles, right? We have like some traditional chartists in here that follow, wedges and triangles and whatnot, right? So it's the same thing here. It's just a little more rigid definition in that it looks for a 5-wave movement in the triangle, okay, labeled A, B, C, D, E. But you know a triangle when you see one, okay? It's 2 converging lines. There's 3 types, right? Symmetric triangles, You can have some sort of derivation, slightly tilted one way or the other, but you know when you see a triangle, it's contraction in price and volatility, right? It gets very slow. Okay, so what governs this wave principle, Elliott wave, and why does it happen? Well, there's got to be some logical, rational explanation. Okay, phi, or 0.618, this golden ratio, is found everywhere, not just by natural activities, but it's found in man's activities as well. Okay, it's found all over, the cosmos. It's found on us, right? We have Fibonacci numbers of digits on 5, right? 5 toes, or most of us probably have 5 toes and 5 fingers, I would think. It's found in measurements in our DNA. And again, the structures of plants and animals. And so the idea is that if it's found everywhere in the universe, including what we do, then it would probably be found in markets, because markets are a product of man. Even automated trading systems, someone had to program those systems, right? So that's the idea of why this shows up. Okay, it's not just some magical thing that happens. There is a reason for it. Okay, so if you're unfamiliar with what Fibonacci is, you start, and you can start with any two numbers, but the importance is in the relationship between the two numbers. Okay, but as you move further out, dividing one number in front of the other will give you 0.618. It's an irrational number, so there is no end. But as you divide the second number divided by the preceding number, you get 1.618. Okay, it's also the only number that, when squared, is, I believe, 1 minus itself. Dividing the alternate numbers yields 0.382. 1 minus that is also 0.382. And again, here's the same figure we saw earlier, right? The golden ratio. All these are Fibonacci numbers. 5 waves, okay, 3 waves, and add them up. So a whole sequence would consist of maybe 34 waves up or 89 waves up. So here's a final exercise. It doesn't really matter what it is, but this is the dollar-yen on a quarterly basis. So if we were to start from the very top, let's see if we can find where the waves are and label them, right? So we have 1, and then the second one will be 2. But within 2, you can probably count 3 waves there too, right? Okay. Now, the next one would be 3, which is usually extended, such is the case now. But within 3, there's usually 5 waves. Okay. Now, the next one, the 4th wave, looks like a triangle, does it not? Look at those magical lines up here. And that top was in 2007. I remember it well. I was looking for the end of a triangle and then a multi-year, maybe even decade decline in the dollar-yen. And you can see how it's declined now. Remember I mentioned that you can have a leading diagonal? That's probably what the decline was from the 2007 high to 84. Okay, I think it was a leading diagonal. But the importance of this chart is relevant. Okay, this is relevant to now because we have not gone below the bottom of wave 3. Okay, in order to complete the entire decline from the beginning of, or the end of Bretton Woods, we need to decline below 80. So this tells me that we are not done declining the dollar-yen. We have been falling for several years, and we may be in a correction for several years. But at some point, the dollar-yen is going to find a secondary top and then decline into the 70s. And that's when we will have 5. Okay? And there'll be much more kind of forecasts like that later today with the advanced Elliott and with the presentation tomorrow on the forecast and the outlooks. Okay, so just to review, right? Elliott discovered the 5-3 pattern in markets, and it bears his name. Remember, there are two basic, at the most basic, there's two types of market moves. There's what are called motive waves, right? The trend effect, okay, that which way the larger trend goes, those affect the movement of the trend. Okay, within motives you have two basic kinds, impulse and diagonal, and corrections move against the trend. Just from a trading perspective, you don't want to trade, after you've seen a motive wave or an impulse wave, it's best to not look at that market for a while, because you're going to get a correction, and you're not going to know what kind of correction it is until after the correction is near its end and you can count it. One way to know that you're probably still in a correction is if you can't confidently count the entire correction, because then it's probably not over and something else is going on. They come back to it later and see if you can count it, and then if you can, if you think a triangle's unfolding, you see, three movements that are contracting, then you have that on alert to wait for the end of the triangle. Okay, that's just an example. And finally, we've got questions. So there might be a lot of questions. That guy's got tons of questions. All right, so I'm just going to start here. I'm going to move all the way up and like that. Sorry, guys, you guys are going to be at the end now.
Going back to the graph, the last graph you had.
This one?
The first wave.
Right.
You don't have any
Right. Well, okay, that's a good question. The question was the first wave. You're saying how the first wave's not in 5?
Right.
Okay, the first wave. Well, if you remember, the currencies were fixed up until the early 70s, right? So we don't have any historical data going back to free market prices. But if I were to, guess the psychology of what would have created this, it probably would have been 3, 4, 5 at some point, right? But there's just no record of data going back that far, so we have no idea.
Robert Prechter started calling for bear market since 1995. If you go back,
I think it was 1987.
okay, if you go back to your chart of back to the
Mm-hmm.
depression or whatever, can you see that why he was doing that? Or
I mean, the question was Robert Prechter was calling for a top since 95, and I think it might have even been earlier than that, like the 80s, 87 or something. But he's saying, looking at a chart of the Dow, long-term chart, can you see why he would have done it? It's hard to say because you can't. It's very easy to say anything, and you look at a chart in retrospect. I know why he does it though, is because he's worried and thinks that the next bear market is going to be so disastrous and end close to 1,000 in the Dow that he doesn't think the opportunity cost of staying in is worth it. That's his rationale. I mean, Elliott is Elliott. Prechter is very smart and great analyst who's made a lot of mistakes for sure, but so has everybody. At the end of the day, you have to, I guess, be self-reliant on what you're going to do as far as trading and your capital. But he's kind of, a lot of people dismiss Elliott because he's been so bearish for so long, right? And maybe he's been he called the top in 08. It worked out very well, but I understand what you're saying. It's hard to listen to it when he called for a lot of tops that haven't happened. But Elliott is Elliott, and Prechter's not necessarily all Elliott. You can look at it your own way. So keep going. I'm moving up this way. So yeah. Oh, okay, that's a good question. Why is 4 not where A is? Well, if you were in real time watching this and you started to see weakness in the late 90s from where the top of A was, you would have thought that was 4. You would have said that's a zigzag. But remember, there's two types of corrections, sharp and flat would include flats and triangles. Well, in something that I'll go into in the advanced section, in the advanced wave presentation is there's the principle of alternation, which says that if wave 2 is sharp, wave 4 will probably be flat. Okay, so wave 2 here, okay, you could see that would, be possibly a zigzag itself, okay? Then wave 4 should be longer, drawn out, and flatter. So rather than having another zigzag like A, you would have thought maybe we'd go for longer corrections. At that point, you won't know it's going to be a triangle. You only know once you can count it, right? But at this point, the evidence is overwhelming that did end as a triangle rather than a three-wave rally to A, because this is all corrective. In other words, you can't really count this as the beginning of an impulsive wave. No, I mean, that's not true. You can never say, most market stuff, you can never say never or always, because it's just, there's always some sort of exception, but they usually are different, yes. 2 and 4 are usually different. In other words, one will usually be sharper than the other, one will usually be more drawn out and, slow. Anything else? Anyone else back in this way? Otherwise, I'll go back here. Yes, sir?
I thought that it wasn't that wave 5 didn't necessarily have to go beyond wave 3.
Wave 5 doesn't have to. You can have, again, this will be something in the advance, you can have a truncation, but I don't like to assume that's a truncation because we don't know yet. In other words, I'd like the market to prove that it's wrong. If we just see a big 5-wave rally from the low in the dollar-yen, then I'll say that could have been a truncation, right? And you get long on the next dip. But in this case, we're moving higher, and the rally's been strong in the dollar-yen, no doubt about it. In fact, I think we're going to 97 or 100, or we've got 97 and 102 targets, okay, for the next several months out. But that might complete a sharp zigzag rally from the low itself. So I don't want to say that we've completed a 5-wave rally, especially when that triangle in wave 4 consumed from 95 to 07 and consumed 12 years. You usually don't end a 12-year consolidation with just, a 2.5-year decline. So that's another thing that I would think.
Okay, now, also, that is quite common, is it not, especially in a short time?
A truncation's not all that common. In shorter time frames, yeah, you have a lot more anomalies, but this is very long. This is a quarterly chart going back to the 70s. So, yeah, you definitely have truncations, but I don't expect them. I don't expect them. And also, it's more likely a truncation if you have a sharp 5-wave rally or something that doesn't make it to the end of 3. Okay, having a leading diagonal, which is rare in itself, with the truncation, those are two. That's like putting the exact on a 20 and 30 to 1 horse. I don't think it's going to work. Well, this exact chart now? I mean, I did say, yeah, this chart, I was saying what this means to me, if I was looking at this, is that the dollar-yen decline is probably not over, and that I'm selling the next big rally. So, and it's not over because we haven't completed 5 waves down, right? So that tells me to look to short near 100 or 102. So that's what I'm saying as far as this. Now, if you were to break this down on a much shorter time frame, you could say the same thing, right? But this exact example, yeah, this means that then there will be a multi-year or multi-month potential for a huge decline in the dollar-yen, right? On the biggest scale, this is a big scale, the impulse move is to the downside, and so we should see big, fast surprises to the downside. Okay, so sharp rally like we're having now in the dollar-yen is probably a zigzag. And getting to the advanced part of the course, we can measure for the end of a zigzag, right? I did show a little bit of measuring here with channels, but we have a channel and we have intersection of measurements coming up in August, later this year. So I'll be looking for a top, in the dollar yen in August, and then establish a longer term short position. Oh, yeah. Well, where to start? Okay. Well, sorry. The question was, how do you know when to start? Which is probably one of the most important questions, right? How do you know when to start? Well, a lot of people want to start from a major high or a major low. I'd say just start when you see a very recognizable pattern. If you see an obvious, and it doesn't matter what time frame, if you see on a 60-minute chart a clear 5-wave movement, then start from there and label that, as one, and see what should happen after the 5-wave movement. Okay, if you then get a 5-wave decline, then look to see if the 5-wave movement that you saw before completed a larger pattern, and maybe it did. Maybe that was a 5 itself. You know what I mean? You don't want to go back and label, every single move in history, because you're not really concerned about what happened necessarily, except for how it impacts what could happen next. So look at, recent history and see if there are any specific things that stick out at you, right? Put a line chart up on a monthly or a weekly. Put up a weekly line chart, closes, and just see where are we in the structure from the 2008 high or something. Do we have a 5-wave down and a choppy rally up that may be corrective? Okay, and if so, then expectations would be for a large decline that would be similar to the first decline that we had. All right. I don't think it broke it on an arithmetic scale. On the Dow or the S&P? I don't know if the Dow did. The NASDAQ and the S&P definitely did. But there's no rule that says it has to stop at the 61.8. It just can't retrace all of it. All the stimulus stuff, right? Again, it's still at the whims of, the psychology of market participants. So I don't think so. Does it affect, all that you said? If it would affect it, then why would we have the decline in 2008 in the first place? And we still had it. We still have 200-point down days. If that was the case, then we would just be very orderly and move, move up forever. But I don't think you can. I don't think you can limit. I don't think you can interfere with market forces. You can print all the money you want, but if people aren't confident, the saving rate is increasing, for example. You can't force people to buy stocks, right? You can print all the money you want, but eventually, if people are not putting the money, back in the market, people are scared about what happened in 2008. Okay, then market forces will win out. For example, even when gold was fixed, it wasn't really. It was fixed, but it started to rally on black markets. Right? Gold was more expensive because even though they were trying to stop market forces, right, from determining a market price, there's still going to be, it's decided that the market forces won out, and they had to take off the gold standard, right? It wasn't like all of a sudden forget the gold standard. gold is worth more than $35 an ounce.
You say that the pattern recognition is easier on a log, semi-log scale?
Well, if you're looking at super long-term charts like this, then you need to look at log scale because it matters, because the big percentage movements are a lot different looking on the arithmetic scale from 25, 250 to 350 than they are from 100 to 200 or something. But if you're looking at an hourly chart, sometimes even a daily chart, over just several months, it's not going to matter a whole lot, especially in FX, because you're not going to have you're not going to have massive intraday 10% moves. I mean, you're going to have a couple percent max. That's a big move. So, 60-minute charts, they look the same. Oh, right here. Well, Fibonacci is the mathematical basis for Elliott. All the 5 is a 3. All these add up. These happen to be Fibonacci numbers, but what's more important is the relationship between the waves. And the next presentation will really expound on that a lot more. But the percentage moves over longer term, and in shorter term, the absolute moves and pips and points and whatnot tend to be related by the Fibonacci ratios, whether it's 1.618, 2.618, 4.235. You get that by taking the next number and dividing it. Okay. After that, you get to 7 something and then 11 something. Okay, but if you go through one potential extension level, say 1.618, then you might be going to the next one of 2.618. Okay, and so on and so forth. But yeah, for example, in zigzags, waves A and C are usually equal or close to equal. Okay, in impulses, I said one of them is always extended. Well, an extension would be considered something that's at least 1.618 times of the shortest wave. And right now, I don't know if we have. Let's see if the internet's set up in here. If it is, then I'll show you some charts on the euro right now and how this is playing out as a forecast for the future. So. Okay, so this is from Thursday, I believe. Okay, and you can see this is a Euro 60-minute bar chart. Notice how, looking at the rallies, each rally continues to be 3 waves, so I'm staying bearish. Okay, and I'm staying bearish against the latest extreme in the impulse. So the idea here was that this is on what I'm just reading off of it, what I wrote. The poke above 37.20 it probably completes a flat. Cannot rule a test here, but the downside is favored against 134.20, right? Because if it went above there, that violates the rule that you can retrace 100% of an impulse, which you can't do. So that means something else is going on. All right, with the euro dollar probably in third wave at multiple degrees of trend, that's the middle part of a large move. This is not the time to get cute with short entries. The next objective is not until 126.20, which is the 161.8 extension of prior impulsive move, which I don't know exactly what it is because I don't have it on here. I'm not looking at the chart, but you can see this is an example of how you can use Elliott, okay, in real time for trading. Now you can see the channel I have here. All right. I'm not going. I don't know exactly. Where the top was. It was near 33.50 on today's open or last night's open. But if I were to guess, I would bet that it ended probably close to that upper channel line right there, that short-term channel line. Okay. So it's the pound. Similar thing in the pound, right? You can count the entire rally from 147.80 as a series of three-wave movements, which is a complex pattern because it's not, it doesn't fit as a flat because a flat would be 3-3-5, but 3-3-3 is allowable under the rules as a complex pattern. And after that, we had a sharp decline. Okay, so I knew I was bearish. I just wanted to have a stop at 55.30 because if it went above there, something else was going on, right? But sure enough, we did, and then we declined. And so the whole point is you have a point where you know you're wrong and something else is happening. But as long as it's below or above that point, then you have the potential to ride a long impulsive wave. So, and combined with the other methods such as understanding highs and lows, when they tend to occur, you can increase the probability, right? You can increase your confidence in market direction. Yeah. I'm sorry? Explain this chart a little bit? Yes, this is a good explanation of kind of degree. Remember I was talking about degree of trend? So this is a 240-minute bar chart. Okay, from the March low, we have everything's a correction. You can see three waves up, and then we had a sharp decline. At the time, I thought maybe that was the beginning of the next wave down, but it stopped, and we got another rally. The rally was also a three-wave rally. Okay. Bottom line is this is not a longer-term bullish chart because we have no impulsive action to the upside. Everything is corrective. So, getting or according to my interpretation of the wave structure, you do not want to be establishing longer-term long positions in the British pound because we haven't yet completed an impulsive decline. We could have a correction that continues to go on, but when you can count the end of a correction and it's relatively close to the current price, you have the opportunity to have a trade against that level with a stop at that level. In this case, the stop would be 155.30, okay, or above 155.30, right? What do you mean point? Where? Well, there is no impulse here. Are you talking about this rally here? Here? Well, there's nothing on here that is a third. You mean this one down, way down here? No, that's this is X. It's a complex. Let's go into complex patterns in the next section, the advanced presentation. Sorry. Sorry about that confusing. Yeah. Well, the best way, this is actually a good way to look at Elliott, is, yeah, you're going to have these news events, and there's no doubt about it that they, increase volatility after the news event, right? But sometimes you get a news event that should make the dollar rally or something, right? But the dollar falls, and sometimes the opposite happens. And you're like, what's going on? This doesn't make any sense. Well, look at the pattern and see where we are. Say we have a strong rally, and the news event comes out, and the dollar tanks. Maybe that's the second wave it's tanking in, and then you know that what's around the corner is a big third wave. Well, no matter what comes out during that third wave, the dollar's probably going to rally really hard, really fast, because the psychology of market participants is exceptionally dollar bullish at that point, and their reaction to news, every news event, whatever it is, which is just a liquidity, at the time, a time to trade with liquidity. Everything is simply bullish. The psychology of the market is going to determine the direction, right? There might be gyrations after a news event, right? If you're in a correction, a large corrective period, you're going to have all kinds of sideways movements on those, you're not going to go anywhere on a net basis for some time. But it's nice to know where you are in the wave pattern, to know when to expect surprises, in which direction to expect them in, So if looking at this chart, for example, I want to know when there's British pound news coming out, because according to here, we might be in a third wave down, right? So I'm expecting surprises to be to the downside. So when a British pound news event comes out, if the initial reaction's up, I'm fading it because I know that I'm in a third wave down. All right. I mean, I don't know I am, but my putting a probability on it, I'm in it with a degree of certainty, right? With a certain confidence in it, right? And as long as we're below a certain level, that's the way I'm treating them. This pair. Put it that way, Well, I have. Yeah, I don't have the. Well, actually, yeah, we can go to charts here. Hold on. Yeah, I'm gonna look for the real chart. Oh, it says it can't display it. I mean, I don't have a charting package on this computer. Yeah, I know. I'm looking for the charts. It says it can't. I think the internet connection's out because I just. What's that? It doesn't look like the internet connection's on. Yeah, I mean, I wish. This happened last presentation too. I asked the only thing I want is a presentation that I'm giving and an internet connection, but it's not on, so I don't know. Hopefully in the next one.
Can you get software that maps all this stuff out for you?
Yeah, there's a lot of that stuff. I don't necessarily think it works that well, though, because to program all the rules, okay, and to always know where the market is in some sort of wave, you just can't do it. Like, there might not be a whole lot happening at some point. There's plenty of markets to trade, so you might as well find the one that has a discernible pattern,
So there's nothing on FXCM that does that? Not on
FXCM, no, there's not. And I'm not. I use Elliott as an analysis technique and a risk management tool, but to be able to force every piece of market action into some waveform is just unrealistic. So, it might be in some massive long correction that you don't know what's going, So there's certain times to look for a trading opportunity according to Elliott. There's really 3 that I look for. I'll talk about at 4:30. But trying to understand every single movement, rationalize it in some sort of pattern doesn't make a whole lot of sense. It'll probably drive you crazy too.
In your previous chart, in your presentation, on the
Which one?
the Roman noodle,
Oh, it's in the presentation. This one?
Roman numeral number 2. Why is C there in Investor 2, but why isn't Roman numeral number 3 in that? Why did you decide that wasn't 3? 3 was down below, and IV wasn't 4, and then 3 down below wasn't 5. You see that? That could have possibly been an Elliott wave. Why wasn't?
Wait, why wasn't this?
Why wasn't that 2? And then,
Why wasn't what 2?
well, your 2's in the right place, but what about the I? Why is
3? That's 3. That's the extended third wave. That's 3 of 3. Because wave 3 itself has to be 5 waves. See, wave 1, 2, 3, 4, 5. You can't. This can't be 3 because this would be 1, 2, 3. You see? You see what I mean? And it also, just proportionally, you know, this second wave here, following whatever this was, remember wave 3 is usually the longest one. So you're going to expect a larger extension. Well, I think that I've got to go. No, I have the next presentation. I don't know exactly what room it's in, but it's at 4:30, and I'm going to go a little more detail about channels and you know, entries and exits for Elliott wave trading. Okay? Oh, all right, awesome. Thank you very much.